perception is that we're a commodity currency, and it's fairly accurate to say that if the global economy slows down, commodities will be less in demand. So this isn't as painful as it is, not really a surprise, at least today.
All right, well, let's find out if it's a surprise to our guest. Diana Avigdor joins us from Barometer Capital. She's taking a short break from trading today to talk to us from the TSX about today's market. Is it good to take a short break from today's market, Diana?
It's very good to take a short break. I was hoping on my walk over you would say something good happened to the markets. Wouldn't surprise me given the volatility if suddenly it was cut in half, right?
Yeah. Well, let me ask you, what is going on today? I mean, what are you hearing? Because it doesn't seem like there's a lot of new information. It just seems that things have sunk in. So what's your take on things?
Right. So last week we had a bit of a rally, right? And it was on a decent light equity volume, but heavy derivative volume. And markets were climbing walls of worry. And then it just seemed like they said, oh, God, here is another wall. So we're not going to climb on top of this. We're just going to run. And risk appetite has really come off. You know, with the Federal Reserve yesterday doing what they did with the Operation Twist, as they call it, they really took away some of the bank's profit center. In other words, you know, they make the yield curve flatter, so now they can't borrow short and lend long and make any money on it. So the banks are still a speculative investment, and they're supposed to be the pillars of our economy. And you look at the banks over in the U.S., and the moves and the intraday are huge. Used to be 20 cents here, 20 cents there, never used to be an interesting trade. But now it's 5 and 10%, and that's not good.
Diana, you know, we've seen moves like this before. It's easy to forget. We all get caught up in sort of the hour by hour and minute by minute thing. But we've seen in the past year or two, we've seen some pretty big swings, and then the market calms down. How are you feeling about coming back to work tomorrow? What do you think is going to happen?
You know, at Barometer, we do things a little differently. What we do is we let our indicators kind of lead us. So our indicators have been have taken us out of certain levels of risk a little while ago, and until they stay down, and yes, things do look oversold, but until it does not turn up, we're not going to stand in front of this train. That's not what we do. We manage exposure as well as we manage risk, and for our clients, we don't have to pick the bottom. It's okay to miss it. So we've seen, you know, last week, if you got caught up in a squeeze, then you'd be hurting this week, and today especially. So it's not a portfolio management strategy of ours to pick the bottoms. We just want to manage the exposure. So we're going to, again, and still stay in capital preservation mode. We do like yield, and that seems to be the only thing that's sort of working. And even in that spectrum, we prefer the very stable, kind of boring businesses with low debt, high cash flow, nothing too fancy, nothing too leveraged.
You're saying that you see things oversold, Diana. What specifically looks oversold to you?
Well, you know, you look at just the indices, and you want to look at oil, for example, energy. You want to look at, you know, copper or things like that. But really, some of these commodities have now, today, maybe yesterday, some of them have broken certain technical levels. It was a hold. It was a make or break type of level. It was either going to hold there or break, and like oil right now is below 200-day moving average. There was another interesting conversation that has been going on in the market among traders on the desk, is that perhaps some of the carry trade is being unwound here as the U.S. dollar is strengthening. We've had the U.S. dollar as the source of the cheap currency or the low yielding currency and staying low for sure for a long time, and the money went into higher risk or risky assets and commodities. And when some of these, when this starts unraveling, when one asset class kind of fails, the leverage in the trade kind of tends to push things to extremes. So we have some of that, I think, going on as well, and perhaps some margin calls and some throwing in the towel. So I wouldn't recommend to stand in front of it until it turns. It may be that we missed the bottom, but that's okay.
We don't have much time left. I just want to ask you a quick question. Do you see today as an opportunity or a sign of more to come, and you should stay out of the market for now?
I think that you want to stay conservative. Like I said, you may miss the bottom, but that's okay, because the volatility in the market has made this market a day trading trend. And so I don't think you can pick the bottom, and I don't think you should. If it's going to go up, it's okay to leave some on the table. It's okay.
Diana, thanks for joining us. Always great to talk to you.
Thank you.
Diana Avigdor from Barometer Capital. Well, the loonie took its biggest plunge in over a year today on yesterday's Fed announcement, and it doesn't seem to be coming up for air. Joining us from New York to talk about the currency market shakeup is Michael Woolfolk. He's senior currency strategist at the Bank of New York Mellon. Michael, thank you for joining us.
Yes, good afternoon.
Let's start with the loonie, just because it's just a